You respond with a yes if you can hear me. We respond with a yes if you can hear me. You respond with a yes if you can hear me. Good afternoon, class. Can you hear me? Perfect. So can you start on the question that we left? That was September. Was it September 2021? We have it as question 1B. I think we're done analysis. We are done an analysis on this particular question. Is that true? So we are supposed to just pick it on, basically we were on what they call adjusted taxable income or loss and tax payable for Pockmark's enterprise. That is on leasing. Pockmark's enterprise, that was basically on leasing. Pockmark enterprise on leasing. On leasing. On leasing. So we can start with that. So say that Pockmark's Enterprise Limited, we call it the Pockmark's. Pockmark's. It's called the Pockmark's Enterprise. Enterprise. Pockmark Enterprise. So we start with the taxable income. That was the taxable income. Income, say for that was for the year 2020. For the year 2020, the taxable income for the year 2020. So it start with taxable. What do you call the taxable operating incomes? What do you call the taxable operating incomes? We own gains. Yes, we are talking about that. As we get that, we talk about that, Ambuche. Is that okay? Ambuche, we are talking about that. So just start it. So manufacturing machine to Pendo Limited, manufacturing machine. So we have the lease rental. That is a machine. Machine that is basically for 12 months. How much was that? Annual lease, how much was that? If we have it here, that was 4.2. So that was 4.2. Then we have the next, we have what we call 10 saloon cars to Samtech tours for 4 months at 40 each. So 10, we are told 10 saloon car to Samtech. 10 saloon car to Samtech for 4 months. So saloon car, lease rental, saloon cars, we just call it saloon cars. So there were 10, each is 40, and they did this for 4 months. How much was that? So I'm saying 10 car, each per month we rent for 40, and basically they're doing it for 4 months. What is the figure for that? So that was 1.6 million. So then you're being told that at the end of the 4 months, Samtech, again, still the saloon car, Samtech at the end of 4 months, at the end of 4 months, we're being told that Samtech towards returned saloon cars, and renewed the lease for additional 3 months. So it returned how many? 4. Are we together? It returned 4 cars out of 10. How many were remaining? That was basically 4. 6 altogether. If it returned 4, how many were remaining? That was definitely 6 altogether. Are we together? That was 6. So again, lease rental, lease. What do you have as the lease rental? We have again saloon car. But now how much is remaining? We have 6 altogether. We have 6 altogether because 4 were returned. But now the 6 that were continued with, there was a discount of 10%. 10%. So we can have, it was done for how many months? However, returned for 3 months. So again, times 40, then times 3 months, and there was a discount of 10, meaning that was 90 over 100. So 6 times 40 times 3, there was a discount of 10%, that's 90%. What is the figure? That should be 6. That should be 648. So then the next we had what's called 5 lorry to Ati Limited at an annual lease, we are told of 800,000 per lorry. However, the lease was terminated after 9 months, after it was found that the lorries had a serious mechanical damage. So we have the lease rental. So we have the lorries. We have what we call lorries. So that should be, there were 5 times 800 times 5. But you say that the lease was terminated after? The lease was basically terminated after 9 months. So basically we apportion, we say 9 over 12. So we apportion. So what do you have when you apportion? So that was 3 million. Aziz, are we together? I hope you're in class. Aziz, Walter, Sheila, Robert Uko, Sharon, Nelson Chengo, I hope you guys are in class. So that is 3 million. Are we together? That is 3 million. Then we're being told that 6 pickups, we were told 6 pickup to Fahari Limited in Rwanda for 200,000 per lorry, for 200,000 per lorry for the whole year. For 200,000 per lorry, we say for the whole year. For 200,000 per lorry for the whole year. Per lorry for the whole year. So we had how many? 6. We are told that 6 pickup vehicles to Fahari Limited in Rwanda for 200,000 per month for a whole year. What was the approach? So the 6 pickups, all of them accounted for 200,000 for a whole month. 200,000 for a whole month altogether. 200,000, we had 200,000 for a whole month, but that was there for a whole year. So we have the lease rentals, rental. So that is the pickups. So pickups, there were 200 for the all 6, but this was basically done for 12. So how much is that? That we got at 2.4. Thank you, Gilbert. Then lastly, on that additional information 1, so being told that computers to Digitech, computers to what we call Digitech, computer to Digitech, and you're being told at an annual lease of 200,000. So what is that taxable income at an annual lease of 200,000? So the figure should be 200. So we have the lease rental income, the lease rental income. What is it for? For the computers. For the computers. And that was a figure of 200,000. And that was a figure for 200,000 together. And that was a figure for 200,000. So then we say less, what you call allowable, less allowable expenses. Less what you call allowable expenses. Less what you call allowable expenses. Less what you call allowable expenses. So we come to this, we have Bookmarks Enterprise incurred the following capital expenditure in the course of the year. Incurred the following capital expenditure in the course of the year. So we look up, we say that purchase of manufacturing machine for leasing. What did you say for that? Purchase of what they call manufacturing, purchase of what they call manufacturing machine for leasing. That was 6 million. We claim investment allowance. So we can just talk about investment allowance, investment allowance. So investment allowance. So we have manufacturing machine. We have the manufacturing machine. What was the rate that we said for manufacturing? What was the rate that we had for the manufacturing? The rate was 50%. The rate was 50%. So 50% times what you have as 6 million, 50% times what you have as 6 million. So what is that figure? What is the figure? That should be 3 million. So that's allowable expense. Allowable expense. Then you say installation cost. We had what's called installation cost. Installation cost and repair of manufacturing machine before use. What did you say? Installation and the repair of manufacturing machine before use. What did you say? We claim. For that, we also claim what we call investment allowance. So were we in agreement for that? Yes, the cost that are incurred before the machine is basically put to use. We claim investment allowance at 50%. At 50%. So we have what we call installation, installation, and repair before use. The word is before use. Before use times 240. So that should be a figure of 120. And I said something very important, that a lot of times, because basically this is tied to this machine. Is that true? So some people definitely look up. Some people definitely will add it to this. Are we together? Some people will add it to this. Will add it to this. Are we together? But the danger with it is that some people may not see. Let's say, for example, somebody was marking very fast. How will you know that there are two entries here? So that's why I always recommend that just try and separate those entries. When you talk about interest on capital, separate them. Some people may not be very fast, especially when they're marking, to see that altogether. So sometimes you can find in certain circumstances you miss those entry. So just make sure that you just break them down. Are we together? Those entries that are as a whole, it takes somebody, maybe when somebody is too fast, you may not see those entries. So just separate them. So then we have the next, purchase of saloon cars. Purchase of saloon cars. Purchase of saloon car. Purchase of saloon cars. So what do we claim on saloon cars? Also investment allowance altogether. So we call it investment, saloon cars, based on the present rate. Yeah, restricted to 3 million. But I'm saying at that particular time, you find before it changed, it was basically 2 million. The restricted value was 2 million, but currently 3 million. So we observe the 3 million. So the 4.2 will have 4.2 times a rate of 25%. What is the rate of 25%? A rate of 25%. A rate of 25%. What is that figure? So that should be, we have it 105,000. Are we together? So then we have what we call a lorry. We have lorry. So the lorry is 1.8 times 25%. So what is that for the lorry? There were two. So we don't restrict. There were two. You don't restrict. There were two lorries. And once, because each is 2.1, so they have not gotten to a threshold of 3 million. Are we together? So you don't do what you don't restrict altogether. They have not gotten to a threshold of 3 million. Each is what? Each is 2.1. I hope that is noted. So then we have a lorry. What is the value for the lorry? The value for the lorry. The value for the lorry. That should be for 50. So then the next we have what's called, what's called administration expenses. So administration, is it allowable expense? Administration expenses. Yes, that should be allowable. So administration expenses, that should be a figure of 2.4. 2.4. That should be a figure of 2.4. So then the examiner tells us that we can have it moving to this side. I hope you can see it there. So we have the next, we're told that we're being told that legal expenses of shillings to 40,000, out of which 100,000 was in respect of defense of an alleged breach of the lease agreement. What did you say on that? On that legal fees, 100,000 was non-allowable, so we less. So the legal fee, on what's called the legal fee, on the legal fee, we have a figure of 240 minus 100,000 for the legal. So the figure should definitely be, we had it as 140 together. We had it as 140 together. If we are at 140, then we respond to this. The figure is 140. So then the examiner told us, again, they're telling us that marketing cost was 300,000, out of which 80,000 being for erection of a billboard for advertising. What do you say about erection for a billboard? Erection for what do you call a billboard? What do we call erection for a billboard? We claim investment allowance. So for the marketing, what do you call the marketing expenses? For the marketing expenses, so we have it as what do you call 300,000 minus 80,000. Minus 80,000. So what is the figure before we claim capital expenditure? So what is that figure? What is that? What is the figure? The figure is 220. So then we can claim investment allowance. So that should be 80. Signboard. That was what you call a sign. Signboard. That was a sign. Billboard. That was not signboard, but a billboard. So billboard. So the billboard should be 10% times the figure of 8. So what is that? That should be 8,000. But we put them because it's so allowable expenses. Allowable expenses. Together. All of us are together. If you're together, we respond to yes. Perfect. So here's where some people were giving me. So a picture of that a pickup whose written down value was for 20, was sold upon expiry of the lease in 2020 for 580. And I ask you, how do you treat gain for businesses? Gain on disposal. Gain on disposal. I know in FR and accounting, gain on disposal, that should be additional income. What about taxation? So gain on disposal. I'm repeating again, for those who are in my intermediate class that I taught on the intermediate, when you talk about gain, we say gain on disposal. Disposal gain is an additional, so that is a non-taxable income. Non-taxable income together. That is a non-taxable income. Are we in agreement? Gain on, yes, is a gain on fixed asset. Are we together? So that is a non-taxable, for the business is a non-taxable income. Are we in agreement? Yes. I know a lot of times when you're consuming a lot of material, there's some material that there's some material I think is noted. There's some material where you find somebody puts it, if you do a lot of research, somebody says this minus 580, and then it claims 25%. That does it make sense? It doesn't make sense. The reason why I told you to do a research was basically to understand that the gain on disposal, that is for business, that is a non-taxable income, that should be a non-taxable income. So together, if we are in agreement, and that should be a non-taxable income. Perfect. So then we move to the next. We are being told that written down values of assets as at 1st January 2020, as at 1st January 2020 was as follows. Again, also, I said something that was very clear on this, Sheila, that again, presently, we do what? We do what? Presently, for the wear and tear, that is at 10% and at 25%. And then when you talk about also IBT, we do it on a straight line, altogether. But even if you look at what you call under manufacturing, we say that for the first year, for the manufacturing and for mining, for the first year is 50%. However, the remaining amount, we are definitely claiming it in what? On a straight line altogether. So if you look at these assets altogether, you cannot claim them forever altogether. You cannot claim them forever. Let's say, for example, wear and tear at 10%. How long do you have to claim it if it's a straight line? How long do you have to claim it? Wear and tear? For 10 years altogether, for 10 years. For 25%, you only have how many? You only have 4 years altogether. And even for the manufacturing, when you talk about manufacturing, the ID, we say there's only 50% for the first year. But the other 50%, you definitely, because you're doing it you're doing 25% on a straight line. So it means even for manufacturing, you only have how many years? You only have how many years? 5 years. So Aziz, what is the implication of this, basically? Especially when you add it on a reducing balance. What is basically the implication of it? Let's say when you are claiming wear and tear on a reducing balance, what is the implication of it? You could claim them forever. When you talk about reducing balance, you can claim it for so many years altogether. That was basically the implication altogether. But then now with this, we have a timeline altogether. We basically have what you call a timeline. Is that noted? We respond with a yes if we are together. We basically have what you call a timeline to claim this. And again, on paper, yes, we basically have a time. But again, if you look at even the assessment, for those who practice assessment, just for those who do it practically, if you look at assessment, in order to, for example, maybe if you had rental property, when you want to claim for investment allowance, especially for IBD, will it be easy for you to get it on practically on the ground? Will it be easy for you to get that? Will it be easy practically on the ground for you to claim for the IBD? Practically, because they'll ask you, when was the building, a lot of stuff. So practically on the ground, it should be, these are some of the areas where you would have to actually have your work in order to claim. So then we move to the next. We have what we call the written down values. So we were saying on this written value, at least we are saying that this counted for initial, because even if we have to get back, we don't know what happened. So we were basically saying that these were what? Initial. The assumption that these were initial values altogether. So that a student does not hold me. The assumption that we're told that the written down value, we are using them as initial values. So we are claiming what? Investment allowance as they are. Is that noted? We respond with a yes. We respond with a yes. Sheila, we respond with a yes. We claim them as they are. So perfect. So we had one, Loris. So we had Loris. The figure is for that Lori we have a figure of 4 million. So that's 25% times 4 million. Some people would have added it. There's a lot here. Some people would have used 5.8, still making sense altogether. Some people would have used, they would have added this with this, are we together, combine them. That would have still made sense altogether. But again, I told you, sometimes, especially when you have a marking scheme that separates them altogether, sometimes you can easily miss that if somebody is marking. So I love an habit of separating those items. Then you have what's called computers. So investment allowance for the computer. So computers, that should be 25% times what's called the 420. 25% times 420. That should be 105. 105. Then we have, we had motor vehicle. We had motor vehicle. What is the rate for motor vehicle? All motor vehicles? All motor vehicle, we're saying 25%. So 1.2. So that should be 1.2. So what is that for the motor vehicle? For the motor vehicle. So motor vehicle, that should be 1.2. What is the figure? 300,000. So the figure is 300,000. Then we have the last one. We call it furniture. Furniture. So furniture, 10%. And the figure for that is 180 times 180 times 180. That should be 18,000. So is there any expense apart from additional income? Is there any other expense? Net taxable operating income. So we can get the net, what we call the net taxable operating income. We can have what we call the net taxable operating income. Do that for me. Do that for me. So what is the net taxable operating income before we go to add other taxable investment income? Add other taxable investment income. So we have it as 32, 37 together. Is that okay? Are we together on that? Perfect. Add what they call other taxable investment income. So the other taxable investment income, the examiner tells us that one of it is interest. We call it interest from Ufanisi deposit, microfinance. The figure is 240, and we are being told that is net. The figure is 240. Is that a qualifying interest or a non-qualifying or interest exempted from tax? What is it saying? That's a non-qualifying. When you're subjecting to taxation, we basically subject it at gross. So we say interest from Ufanisi deposit, what we call interest from what we call Ufanisi enterprise. Interest from what we call Ufanisi, that should be, withholding was 85. So 100 times 85 is 240. The gross is 100 over 85 times 240. So that is 282. So we have 282, 353. 282, 353. So then we have the next, what you have as dividends from Wananchi Sacco. The figure is 120 net. What is dividends from wananchi circle? How do we treat dividend from what we call wananchi circle? That is qualifying. To mean what? The 5% withholding tax is final. We don't subject it. What about royalty income of 400,000? Royalty income, we do what? That one is subject to further taxation. So we have the royalty income, the royalty income. So that should be, the withholding was 5%. So the gross should be 100 over 95 times a figure of 400,000 times a figure of 400,000 times a figure of 400,000. So that's a figure of 421, 053. 421, 050, 053. 421. So then we have what's called the total taxable income. What do you have as the total taxable income? What is the total taxable income? Add that. Total taxable income. Give me the total taxable income. So we have it as 394,406. 406. 3940, 406. So together, team. Together, team. All of us, we can say we are together. So I insist again to my students. The answer is not a big thing. The big thing is that I repeat it again. Try as much as possible to have what you call 75% to 100% of the entry. This is key for me. Along the way, because of time, because of you're working against time, and sometimes you read some entries and you don't understand, make sure at least you make 75% to 100% of the entry. I'll be happy. Once you do 75 to 100% of the entries, that will be enough. So we get the second part. I will take the second part is what you call the tax payable. Tax payable. Tax payable. How do you tax this? How do you tax leases? We say that there's definitely two types of lease, the finance lease and the operating lease. But for taxation, we basically tax them the same altogether. So how do you tax this? How do you basically tax this? Remember, this is resident. How do you tax it? We tax it at, we say that we tax it at 30%. So we have 30% times 39. We have it 3940, 406, 406. So what is that 30% before we less the credit? Less what we call the tax credits. Less what we call the tax credits. What is 30% of, and the key thing is not the answer. The key thing is the student just understanding this is 30%. The answer is not what you get here. The answer is the student understanding that you basically tax this. The marking point is 30%, is 30%. Sheila, together. So whether you had gotten your 1 million there, so when you come here and you just show this 30%, then that should be okay. Okay, 182, 122. So don't lose free marks. So we less the tax credit. So there's a withholding tax on interest from ufanisi. Interest from ufanisi. Interest from ufanisi. So the interest from ufanisi, we know that is 15% times the gross figure is 282, 353. So what do you have? What is that? Withholding. Then you also have royalty, the withholding on royalty, that is 5% times what do you have as 421? We had it as 053. So get for me those that we need to less. So the first one is 42. We have it as 42, 353. Somebody to confirm. Is that right, Aziz? Is that figure right? N21. Are those figures right? So that others also to be engaged. Perfect. Then you have what's called the net tax payable. What do you call the net tax payable? The net tax payable. What do you have as a net tax payable? The net tax payable. So get me the net tax payable. You can get that answer. So, but the main points are this. Then you have that. The main points are those. Not even that. So you can get the net tax payable. This you list that and you have that. What is the net tax payable? The net tax payable, team. What is the net tax payable? So we have 1118, 716. 1118, we have 716. 1118, and the figure is 716 together. I think this question is understood. I don't think so if there's a challenge in this question. Is there a challenge? Is there a challenge in this question? Is there a challenge in this question? All of us, is it understood? Is it perfectly understood? Perfect. So there's an assignment for that. I think this assignment you can basically do this assignment so that we do assignment on the leases. April 2022, question 5C. No challenge at all. This one you should not even go for the second. That is April 2022, question 5C. April, check April 2022, question 5C. Question 5C as your assignment. See, all of us, you can do this by yourself. I only have two people that have the assignment, but I've marked those assignments. The only thing I want you to communicate with them, that is Walter and Sharon. I have marked the assignment. So if you did not send your assignment, you can create time and send. But I only have two people. Assignment for two people only. So there's no challenge. So you can do this for me. So I want us to go to these smaller ones, these smaller areas, and I say that by next week we should be on administration of VAT. Are we together? Next week we should basically be on the administration of VAT. Are we together? VAT and administration of VAT and the tax investigations. Yes. Can I wrap this now? Are you going to do this just to make sure? Because we've done it one. Perfect. I want to try and sort this smaller one, circles, taxation of A and C, so that if you work on those are smaller questions, very small questions, very, very small questions. So that one we can actually do two. So that is the taxation of A and C undertaking. Taxation of what they call of A and to say and C undertaking. Taxation of the A and C undertaking. Taxation of what they call the A and C undertaking. Are we on that? Are we on that? Open the handout. Are we on the handout? I want to discuss it as we open the handout. I know that some people don't see those handouts, but I want you to open those handouts so that even as you follow up what you do. Are we on it? Are you able to see taxation of A and C undertaking on that handout? I want it to be open. The reason why I do that, very important. So open that handout. These are much smaller. So if we work on them very fast, somebody to share. Somebody to share that handout. So you only just need to discuss shared. So say taxation of A and C undertaking. So basically, when you talk about taxation of C and A undertaking, we say that this is taxation on what we call owners of ship and aircrafts. Taxation on owners of ship. That is a taxation. We call it taxation of what we call owners of ships, and say in aircrafts. We say operating in Kenya. Operating in Kenya. Taxation of owners of ship and aircrafts operating in Kenya. Together, team. And you say they're taxed. If you look at the taxed, the basically taxed, we have 30% and 37.5%. 30% is for what? 30% is for the resident companies, what we call the resident companies. 30% is what called for the resident company. And then we have the 7.5%, that is what you call a non-resident company. So under this, there's only one thing that is a bit technical in this. There's only one thing. Once you understand that concept, then this should be much easier to get them. So we know that determination, what we call determination, we have what we call determination or what we call taxable income. How do you determine the taxable income? We say we determine using the net profit method. We have what we call the net profit method. Net profit method. And then we have what we call the gross profit, what we call the gross profit method. So again, we have discussed this at length. When you talk about net profit method, is basically when the accounting profit has been provided. That is the net profit. So you adjust what we call the accounting profit to get what we call the taxable. So for the gross profit, accounting profit is not provided. Are we together? So this basically applies to ship and aircraft operation. So very important. So we say for non-resident, well, that is when it comes to non-resident. So what happens? This is the only point that is sometimes a bit technical. So I think for non-resident, are we together? For non-resident, we say that income, this is the only point, incomes generated. We say that the income generated en route. We say income generated en route from other countries. We say from other countries. We say income generated en route from other countries into Kenya. The word is that incomes that are generated en route from other countries into Kenya. The word is usually. We say exempted. is usually exempted from what we call tax. This is basically exempted from tax altogether. So this is one point that students need to note. I hope that is noted. So income that are generated from the other routes into Kenya, that income is basically exempted from tax together. So that is exempted from tax together, team. We respond to the yes if you're together. So when you see income from other routes into Kenya, that should be basically exempted from tax. Then lastly is basically investment allowance under ships and what you call and the aircraft. And you say we use what? Particularly when you do this question, I've said income generated en route from other countries into Kenya. En route, as I've said, income generated from en route from other countries into Kenya, we say this is usually exempted from tax. Together as is. En route from other country into Kenya is usually exempted from tax. As is, if you're together, you give me a yes. You give me a yes if you're together. Yes, coming from other countries into Kenya. That is income en route from other countries into Kenya. That one is exempted from tax. That is a key point that you need to note on this. And I think that's the main idea on that. Because a lot of times students will always confuse that. So we respond with a yes. As is, we respond with a yes. Perfect if you're there. So lastly, is basically investment. I will talk about double taxation agreements. We'll talk about on issues to do how we work on the double taxation agreement. We'll talk on double taxation agreements. Just hold it. On double taxation, I will talk about it perfectly well. So don't worry. On the exemption clause, the credit clause, we'll talk about the double taxation perfectly well. So investment allowance under ships and aircraft, that is very clear. We read it on the paper. What is the current rate? Not the rates that were being used before. The current rates on ships and aircraft, we say 50% in the first year and 25% on a straight line on the remaining balance from the second year together. We have said that for ships and aircraft, it is 50%. We know that 50%, we say in the first year, 50% in the first year, and 25% and 25% on a straight line, we say on the remaining balance. On the remaining balance. So 50% in the first year, and you say 25% on a straight line on the remaining balance. And we are using it, any question that I will pick, we are using the present rate. Together, team, we use the present rate. We use what we call the present rate. We respond with a yes if you're together. Allow me to do one more question. These questions are very small. Allow me before I give you a break. Can you allow me to do one? Can you allow me to do one before we get to a break? So then I do one more. So I have what's called May 2018 question 4A. May 2018 question 4.1. May 2018. Then I also pick a very present 2022. And I think, was it set the last thing, May 2020, May 2018 question 4. That is question 4A. Allow us to do this before I give you a break. Then you come back and do one. These are very small. We will not take long on these ones. So open that question. We open that question. So we open that question, May 2018 question 4A. We open that question. Are we on it? Are we on it before? And we come and do a very present question. All of us, are we on that question? May 2018, question 4A. Yes, Jacob's air. Yes. Then we do a very present question. I know we love very present questions. I know students love very present questions. Why is that? Why do we love questions that are very present? Students particularly love questions that are present. Let me open it just a few minutes. But I do it for a reason. Anytime I pick a question, there's always a concept that I'm passing on those questions. So I'm almost there. I think I'm now there. So are we on it? Can I start reading it? Can I start reading on it? Can I start on it? But now the structure for this question is the same. This question, they have not been very creative. The structure is the same. So being told that Jack's Air Safaris, so being told that the Jack's Air Safari Limited, the word is a foreign company. The word is a foreign company operating a fleet of passenger and cargo aircrafts in Kenya. Operating what? A fleet of passengers and cargo aircrafts in Kenya, Middle East, and what we call the Far East. So then you're being told that the operating results for the year ended, that is 30th September 2017, is as follows. So one is income, that is Kenya to China, a figure of 1 million. In fact, that's a billion, but round it off. So 1,567,720. Is that a taxable income or not a taxable income? Is that a taxable income or not a taxable income? Is that a taxable income? That should be taxable, Robert. So then we have income from passenger and freight, that is Kenya to Middle East. The figure is 1 million. The figure is 1,765,000. Is that taxable? That should also be taxable. Then, Aziz, I want you to be very keen on that concept that I was saying. Income from passenger and freight, and they're very specific. That is South Korea to Kenya. Is that taxable or exempted? That is exempted from tax. Are we together? That is on route from other countries into Kenya. That is basically exempted from tax. Are we together? And if you look at taxation and all these customer units, once you understand the concept behind what you're doing, is it not easy? Once you understand the concept behind what you're doing, do you think it's technical, Aziz? Once we understand the concept, the key thing is always just the concept. And I've also shown you that you don't need to be correct 100% to have everything right. Are we together? You should not know everything, every entry. But once you understand the concept, then everything should flow. So then we're being told that income from cargo into aircraft on all other routes. Is that taxable? Is that taxable on all other routes? So you're being told that income from cargo loaded into aircraft onto all other routes. And now that will be made easy. That should be, no. Sheila, look at the word. Look at the word income from cargo loaded into aircraft on all other routes, meaning that this is operating in Kenya, but pushing them to other routes. It's not from Kenya to all other routes. So that should be TIM. That should be taxable. So that should be taxable. You say that income from cargo loaded into aircraft on all other routes, that should be taxable. To get that in, we respond with a yes if that is right. So then we're being told the next is salaries and other expenses. Is that allowable expense or non-allowable expense? What they call salaries and other expenses, that should be allowable, but maybe subject to additional information if there is additional information. So then we're being told the next is what's called accumulated depreciation on aircraft. Accumulated depreciation on aircrafts. So that is a non-allowable expense. Then the examiner tells us that general provision, what they call the general provision for bad debt, that is a figure of 72. General provision for bad debt, that is a figure of 72. How do we treat general provision? How do we treat general provision? That's non-allowable. So then there is a small, there's a small additional information here. There's a small additional information. So then we are being told salaries and other expenses. So what we call the salaries and other expenses include number one, purchase of plane engine. Purchase of the plane engine. Purchase of what we call the plane engine. So plane engine, that's a capital expenditure. We claim investment allowance on it. So on that salary, we are basically going to deduct. We are going to deduct altogether on that salary. So then we have the next one. We have what we call use of airport facility. How do you treat use of airport facility? Use of airport facility. Is that allowable or non-allowable? Use of airport facility. Is that allowable expense when you say use of expenses that you incur to use airport facility? The question is, when you incur expenses, particularly the logic, how do you treat expenses that you incur to use airport facility? How do we treat them? Are they non-allowable? Are they non-allowable? Expenses that you cut, those should be allowable expense. Though they are on salary, but they are allowable expense. Are we in agreement? T has got it right. The expenses that you incur, you see, because the airport facility is what generates what? That's what those are some of the expenses that aid what? Generation of income. So the expenses that you incur to use what you call airport facility, those should be allowable expense. Are we together? Even if you deduct it, you have to write it back as an allowable expense together. We respond with a yes if you're together. Perfect. So then we have the next, what we call hotel bill for first class passengers. Hotel bill for first class passengers. How do you treat hotel bills for first class passengers? Are those allowable expense or non-allowable expense? Why do you say non-allowable? Why do you say non-allowable? If you look at the first class passengers, in terms of their generation, in terms of how much they pay in the ordinary, just a minute, Uko. I was on expenses that we incur. Are we together? Expenses that we incur, we say discriminative, but this case pay a higher amount. Let's say, for example, if you're paying a ticket, so I'm saying for the first class, I'm seeing questions here, like, for example, here, we have JK, I have a plane, and so, for example, I'm saying, Yes. You see, in that case, these guys, for the first class, in terms of what they pay, is it equivalent to the ordinary passengers? The first class. Is it equivalent to the ordinary passengers or the first class? No. So again, it's something they incur. Yes, the lower class, you find they cannot give such an offer. Which together for first class, they will give you. Which no wonder what first class owners can access is different from a lower class. So when you incur an expense basically for the first class, then that should be allowable. I'm saying that should be allowable. Together, team, I want us to agree. So that should be allowable expense. I want us to agree. That should be allowable expense. Then you have the next accommodation for the airline crew. That should be very outright. Accommodation for the airline crew. How do you treat accommodation for the airline crew? That should be allowable expense. So for the accommodation of the airline crew, that should basically be allowable expense. Then you say gift to the airport staff. Gift to the airport staff. That is non-allowable. When you say gift to the airport staff, then that should be Sharon. That should be non-allowable expense. When you say gift to the airport staff, that should basically be non-allowable expense. Then lastly, we're being told that the airline has a fleet of aircraft whose total cost before accumulated depreciation is a figure of 360 million. Those ships, what are we going to do with it? We are going to claim investment. Yes, those are areas of evasion, very big areas of evasion. Are we together? That's why we have a cap. You notice that when you talk about benefit in kind, there's a cap. Are we together? Are we together? There's a cap. There's a cap. Are we together? So that you don't overuse it. Robert. Yes, that's why when you look at even benefits in kind, there's a cap on it so that people don't do what? Don't use them to mess up revenue collection. So can I start the question? Can I start the question? Perfect, if I can. So the question is, we're being told that statement of total taxable income for JEX Air Safari Limited. So we say JEX, JEX, we say Air Safaris, JEX Air Safaris Limited. JEX Air Safaris Limited. So the JEX Air Safaris Limited. So we start with the taxable operating incomes. So we say taxable operating income, taxable operating income. So we have it there. So we say that income from cargo, income. We say from cargo, that is Kenya. We have it as Kenya, China. That should be 1567. So that should be that. So then income, we say from passenger. From passenger, we call it passenger. And what we call in freight, passenger and freight. So we have it Kenya, Middle East. Kenya, Middle East. So what is the figure for that Kenya, Middle East? That should be 1765. That should be okay. I hope you're following. We say that income from passenger and freight, income from passenger, so freight, that was South Korea. So that is exempted together. That is exempted. Let me just add ink and my pen. Is Katerina in class today? Is Katerina in class today? I hope he is. So income from cargo loaded. Say from cargo. We talk about loaded. Loaded. We say on all routes. Together. So what is the total for the taxable operating income? What is the total? We can just go to less allowable expense. Less what you call allowable. Allowable expenses. Allowable expenses. So we have we had salaries and wages, salaries and other expenses, salaries and other expenses. So on salaries and other expenses, we had a figure of 1,548,548. We less 548. We less. We said that engine 117. We less the 117 and gifts. And gifts. So what is that? Salaries and wages. Butch has already gotten for me that. So when you less this 1,548,000, you less 117, that should be for 2,200. So the reason why we say salaries and other expense, so we don't need to separate it. We don't need to separate that salaries and other expense. So any other expense apart from that, any other expense apart from that, any other expense. So we have investment allowance. So investment allowance. Under shipping, we have engine, but we use the present rate. We say we use the present engine. For the ship, that should be 50% times. That is not a motor vehicle. So how much should that be? Then we have a fleet of aircrafts. So we have aircrafts. So that should be 50%, but you round it to thousands. If you round it to 1,000, that should be times 360. Times 360. Give me those investment allowance for that and that. 58,500. And this should be, that should be 180. That should be 180. So at this point, we have what we call net taxable operating income. Net taxable operating. So what is the net taxable operating income? The net taxable operating income. The net taxable operating income. So we have 2,304,020. So together, all of us, are we together? If you're together, we respond with a yes. Kindly, we respond with a yes if you're together. If we are together, then we respond with a yes. Perfect if you're together. So then what is the tax payable? Because the first part is 8 months. Then you have tax liability. Tax liability. That's 7 years because that's a foreign company. So tax liability. That should be 37.5 times 23,04,020. And look at that part B. The part B is 2 marks. So 2 marks is basically for understanding this, and you have 2 marks because you'll have your own value. In most cases, you find students not having that. So 2 marks is basically given for understanding that. 37.5%, you have your 2 marks. So that's 864, 864, 008. Have you understood that question? Is that question understood? Perfect. So we can have our break, then we come do one. These are smaller and introduce something smaller too. Yes. Or you don't need a break. Do we need a break? We don't need. We can have it then. You remind me, you make sure that you check. If Mwalimu forgets to tune back, just let Mwalimu know. Somebody to find the paper in the group, the paper that I sent. Let me just check it. I have it now. So let me open it. The paper. December 22, question 2A. Just a few minutes, and I get it there. So I have it, perfect. So we can read it. So we're being told that Mawingu Limited, the examiner tells us Mawingu Limited. The examiner tells us Mawingu Limited is a foreign subsidiary company operating a fleet. Is a foreign subsidiary company operating what we call a fleet of passenger, and cargo aircraft in country A. In country A. The flights are between country A and other countries. The flights are between country A and other countries. Then you're being told that the operating results for the year ended, that is 31st December 2021, were as follows. So then you're being told that income, that is from country A to country B, the figure is 567, 520. Is that taxable income or not a taxable income? Is that a taxable income or not a taxable income? Is that a taxable income or not a taxable income? That should be taxable income. Then you're being told that income from passenger freight, that is from A to C, the figure is 765. The figure is 765. So then we have the next, what we call income. Now we're being told that income, that is country C to A, that should be exempted. Then we have what we call income from cargo loaded into what we call aircraft on other routes. Is that taxable? That should be taxable. So then you say salaries and other costs. Salaries and other cost. Is that allowable expense or non-allowable expense? That should be allowable expense. Then you're told depreciation is a figure of 288. How do you treat depreciation? How would you treat that should be non-allowable expense? So then we're being told that capital, before that, general allowance for credit. General allowance for credit. How do you treat general allowance for credit? That should be non-allowable. Then you're being told that capital expenditure, we have the cost of 2 billion. So capital expenditure, on the capital expenditure that is non-allowable altogether. Capital expenditure should basically be non-allowable expense altogether. So then we have what we call compensation for the stolen baggage. How did it call compensation for the stolen baggage? That's not an income. They are the ones who have compensated. It's not an income. It is not an income. That's allowable expense. They are the ones who are compensating. Compensation. The incomes are up there. If they compensate, that should be allowable expense. I hope that is noted. So then, if you look at that question already, if you look at that question and what we did, is it the same structure? If you look at that question, and I want you'll also check as you do the April 2025 one, you look at the structure. Is it the same structure of the question? And in fact, for this, the things that are similar. Are you seeing things that are similar? And where there's alteration is a small alteration on that question. Is it true? Sheila, are you able to see that? And if there's alteration, if you check that question and this question, you see the structure is not the same. So then they tell us salaries and other costs include, number one, you're being told purchase of twin engine. That's non-allowable. That one we should less. Use of airport facilities, that's allowable. That should be allowed. Then you have hotel bill for passengers. Hotel bill for passengers. We have accommodation for airline crew. That should also be allowable. Then gift to airport staff. Gift to the airport staff. Gift to the airport staff. That should be non-allowable. So on that figure, we should deduct what? We should deduct, which item should we deduct on salaries and other costs? What should we deduct on salaries and other costs? What figures should we basically deduct? 117 and the gift. Perfect. So then the examiner tells us next that investment allowance were agreed with the Revenue Authority at 85% of depreciation. So what is the investment allowance? Were agreed by investment allowance, what is called the investment allowances. Were agreed to be what? We have it as 85%. We have it as 85% of what? 85% of depreciation. That should be times. That's the only unique thing on that. So you get that investment allowance. So that should be 244. So we have it as 244,800. Together, team. 244,800. Then you're being told that assume that corporation tax rate is 30. So what are you going to use in this question? What are you going to use as corporate rate? What are you going to use? 30%. The examiner is clear. Assume that corporation rate is 30%. It came in the last. On April, I've given you assignment here, Robert. It came in the last sitting. Yes, it came on the last sitting. It came on the last sitting. So then you just use 30% because the examiner is very clear on 30%. So then you're being told that compute adjusted taxable profit or loss of Mawingo Limited for the year ended 31st December 2021. Then the second, you're being told that compute tax payable or refundable. Tax payable or refundable. Is it doable? That is doable. With the time that we have, I think in the next class, I should be able just to put it down because I have another class in the next 10 minutes. So instead of trying to push you to the 10 minutes and squeeze it, we can just put it. The next class when I come, I'll just put it there. But I know by that time, some people would have done it. So you'll counter check. By that time, some people would have done it. So definitely you counter check, counter check. Is that okay? So by that time, you would have done it. So some of us will counter check. But remember, the next class, I'm very strategic on how I'm doing some things. So I'll come with specialized. I don't specialize. Specialize. I'll just summarize what I need us to do. Whatever I will have not done, if it's one area or two area, that is the first area that I start on blocks together. But by the end of this month, I should be done with administration of income, administration of VAT. I'm sending that handout. Administration of VAT and tax investigation. Those two handouts should be done. I should be done. Yes, that should be less. That is the investment allowance. So the examiner tells you that investment allowance is basically, remember this depreciation is non-allowable. So investment allowance is 85% of depreciation. So you less it from allowable. Sheila, that's okay. You less it from allowable expense. That now becomes allowable expense. Thank you. So I want to say thank you. This is an amazing class. And I know with God, yes, happy Father's Day, Oko. I know with God and the good work, tax should be made simpler and easier. So that when you get to that exam, do it in the shortest time possible. And you know you've done well. Together, we must overcome all this. There's no any other way. We must overcome. Yes. Thank you so much. Thank you so much. Happy Father's Day to other fathers too. Thank you, Gilbert. Thank you, Sharon.